Hi everyone, my name is Aditi Goswami and today I'll be talking about W.D. Gann's book, Truth of the Stock Day. This video is the second part of a 4-video series where I'll be analyzing and discussing what I learned from W.D. Gann's book, Truth of the Stock Day. Before I start discussing the book, I urge you all to subscribe to this channel so that you'll be notified when I upload the subsequent parts of this series. As you can see, there are 4 parts that I'll be discussing in this series. So in this video, I'll be talking about how we could trade better. Starting with rules for successful trading, the first one is considering the amount of capital needed for you to invest in a particular stock and knowing how much you need in order to decide to get out of a trade. Having a stop loss while trading is always recommended. This is what the second rule suggests. People think that the stop loss will always be triggered, but what they don't usually understand is that it is always better to get out of a trade if you're wrong. The third rule talked about avoiding overtrading. Traders always need to decide beforehand how much profit they need. Usually, when a trader realizes that they were wrong, they buy or sell more to average out the loss. This is extremely risky and is definitely not recommended. The fourth rule talked about trying to never lose more money. We as traders need to realize that we are wrong and get out of the trade rather than risking losing more money due to hope. The fifth rule talks about going with the trend rather than against it. It talks about the same things like accepting when you're wrong and not being in a hurry to buy when the trend is clearly bearish. Being 100% sure about the stock that we're trading in through our own analysis is very important. If you find yourself doubting the trade that you've taken, it is better to get out of said trade. The seventh rule suggests trading in active stocks only. This makes sense because that's where we'll find the most fluctuations and hence we'll be able to earn more profits. Another thing that we need to keep in mind is to have a diverse trading portfolio consisting of stocks that we know properly and staying away from those which have been consistently giving us losses. The ninth rule again talks about setting a limit for both profits and losses. We also need to be patient in our trades and stick to our analysis. Moving on to methods of operating, we firstly need to talk about buying outright and selling short. I had mentioned in my previous video that we need to realize our natural biases and figure out whether we are a natural born bull or a natural born bear. Many traders make the mistake of only buying stocks and not selling short when given the opportunity, and thus missing out on profits for no logical reason. If your analysis shows that the market will go down in the near future, rather than waiting for the opportunity to buy when the prices are at its lowest, you as a rational trader should sell short and then buy when the price is low. The next topic is pyramiding while trading. Pyramiding basically means that you should increase the orders if an asset performs well and continues to show upside potential. Moving on to scaling, this means avoiding buying a stock all at once and buying multiple orders at different prices so as to limit the impact of putting in one big order. This helps us to minimize our risk. The last method is to follow the rules you have personally set for yourself as a trader. Moving on to charts and their use. W.D. Gann over 100 years ago also realized how important technical analysis really is. That time when the prices were only shown on a ticker tape, he acknowledged the importance of analyzing the prices and their highs and lows over weeks and months ago to figure out the future trend. Quoting W.D. Gann, charts are merely records of the past, but the future is nothing but the repetition of the past. Next, we'll talk about the 7 zones of activity. There are 3 zones above and below the normal zone. The normal zone is basically something near actual intrinsic value of the stocks. We consider this as a zone where buying and selling is about equal and fluctuations are very narrow. There is no reason for any wild speculation in this zone. The first zone above normal marks the period of quiet advancing prices, which doesn't attract a lot of attention. The second zone above normal marks a period of greater activity when pools begin marking up stocks. The public becomes more interested in the market and buys on a small scale, but most people will wait for a reaction back to zone 1 to buy, which rarely happens. The third zone above normal is the zone of distribution. This phase has the most activity and wider fluctuations, which are better for us as traders. Moving on to the zones below normal, we start with the first zone below normal, which is marked by a quiet decline from high prices. The second zone below normal is where liquidation increases. People are less hopeful and become more conservative about buying. The third zone below normal is exactly the opposite of the third zone above. It marks a period of panicky conditions and extreme pessimism among traders. The end of the third zone is where buying usually starts, as the prices are at their lowest. Next, we talk about the habits of stock. As per W.D. Gann, the stock market acts the same way as humans, since it is controlled by them. Just like people, the market also has its own habits, which we analyze through the technical analysis of charts. The first habit can be seen through support and resistance levels. We can see that the prices always bounce up or down at a particular level. Support and resistance levels can be seen through indicators such as supertrend or Fibonacci retracement levels. The next habit is the shape of tops and bottoms of a particular stock. The stocks that lead and reach the top first make flat tops. That is, they reach a level and stay there for several weeks or months. These stocks, of course, are the first to lead a decline when a bear market starts. The stocks which are late movers and start their advance after the general market is about top are rushed up fast and make a sharp top. They do not remain long at top levels but decline quickly because the general market has already turned downwards. The last topic is the time needed by a particular stock for distribution. When stocks reach a level where distribution is taking place, there is a large volume of trading and both short selling and buying is taking place. People are attracted to the stock that makes fast moves up or down because there are great opportunities for making money. Some of the surest signs of distribution are fast moves up and down on large volume. The last topic is about reading the tape correctly. During the time of ticker tapes, W.D. Gann suggested staying away from it or looking at it from far away, meaning looking at the bigger picture. A trader looking at the price constantly cannot see the bigger picture and thus is bound to fail sooner or later. It is thus important to study charts. Thank you all for sticking with us till the end of this video. Like I said before, I'll be uploading the following parts soon, and if you would like to be notified when I do, I suggest subscribing to our channel Together Investing Club. Thank you.